Convertible securities is a combination of a bond and shares of an originator. Now let's see how convertible securities are advantageous to both issuer as well as the investor. First, let's examine its attractiveness from the issuer's perspective. From the issuer's perspective, the advantage lies in the fact that as compared to a pure debt instrument which does not offer an option to convert to its investors, convertible securities is giving that flexibility. Hence, it enables the issuer to raise funds at a lower coupon rate as compared to a pure debt instrument. From the perspective of the investor, the advantage lies in the fact that it offers a potential upside to the investor when the stock market is rising. So when the stock market is rising, the investor can exercise his option of converting convertible securities into shares and can gain a possible upside. Additionally, in a country like India with poor bankruptcy outcomes, convertible security offers a very important flexibility to the investors. The investors can exercise their option and convert their convertible securities into shares, take charge of the assets, and sell in the market to recover their money. In this way, we see that convertible securities are very flexible investment options and they offer very attractive returns to both issuer as well as the investor. So SEBI recently issued a discussion paper inviting public comments on the regulatory framework of convertible securities. The three specific questions that they wanted public to comment on were: firstly, should the pricing of convertible securities be prefixed or should be linked to the market? Second, should offer for sale be allowed for convertible securities? And third, should convertible securities be regulated like a debt instrument or should they be regulated like an equity instrument? We feel that the third question is of particular importance as far as the regulatory framework of convertible securities is concerned. Let's examine the analytics of a convertible security before answering this question. What is a convertible security? It is actually a combination of a bond and a warrant. What is a warrant? Warrant is an option which is issued by the company to its investors. So when an investor exercises the option, when an investor exercises the warrant, the company creates new shares in favor of the investor. So in this framework, what is happening is that the price of convertible securities is dependent not only on the bond, it is dependent on the warrant. And warrant in turn is dependent on the price of the underlying shares of the issuing company. Whenever an investor is investing in the convertible securities, he is factoring in a certain kind of return which is intrinsically linked to the performance of the company. So what is going to be the future of the company, what's going to be the stock market performance of the company, all these things are factored in when an investor makes a decision to invest in a convertible securities. This aspect makes it more favorable and more closer to an equity instrument rather than a debt. Because for a debt instrument, the defining characteristic is that it offers a fixed rate of return. Whereas in this case, we see that the performance of a convertible security and the rate of return it offers is intrinsically linked to the performance of the company. This makes it closer to an equity instrument. Hence, we feel that the framework of convertible securities should be closer to an equity instrument. The case for state intervention arises only if there is a market failure. When market is not able to yield efficient outcome, state intervention is warranted. In the case of convertible securities, the only form of market failure arises in the form of information asymmetry. There can be two possible scenarios of information asymmetry in the case of convertible securities. One form of information asymmetry arises between the issuer and the subscriber, where the subscriber is not quite clear about the terms and conditions of conversion. The other form of information asymmetry arises between the issuer and the existing shareholders, when the existing shareholders are not aware of the extent of dilution that they may be required to face when the convertible option is exercised by the subscribers. Only in this case, state intervention is warranted. And what kind of state intervention? The state may prescribe stricter disclosure norms as compared to a pure debt instrument or as compared to a pure equity instrument. In addition to this, any form of state intervention in the form of prescribing pricing norms or disclosure or listing norms is not warranted. Currently, if we look at the regulatory framework of convertible securities, we find that the regulator has prescribed different norms and different requirements for different for different classes of investors. For example, for preference investors, there is a different tenor requirement. For a classified institutional investor, there is a different tenor requirement. We feel that all these kinds of regulatory interventions are not required. They do not serve any purpose. Such kinds of decisions as regards the pricing, as regards the maturity profile, should be left to the commercial wisdom of the investor and the investee. The only form of state intervention required is to fix the information asymmetry problem.